Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we will help you learn to invest in 15 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going, bro?
I'm very good, Bryce. How are you?
Good.
That's good.
Good.
I still think we need to change the intro and stop saying 15 minutes or less, because I don't reckon we've done one episode that's been 15 minutes or less.
We started strong with the 15 minutes or less thing, and then as we have progressed, we're falling back into old habits.
Old habits die hard. That is a saying.
Yeah, maybe I'll change it to maybe we'll change it to 20 minutes.
Give us some flexibility. Say 35 minutes or less.
No, it doesn't have the same ring.
True.
Maybe I'll say 15 to 25 minutes or less.
Approximately 15 to 25 minutes. Sometimes a little longer if it's
give or take, not including ads and stuff.
Yeah. Asterisks. Yeah.
All right. Well, we need to review that.
Yeah.
All right.
Why don't we just say we break down the world of investing in exactly the right amount of time.
Hold on. You're a very intelligent young man.
All right. I think I just secured the funding with that one. If people don't get the reference, follow Elon Musk on Twitter.
Yeah, check out his Twitter. Maybe
before he goes to jail.
Follow us on social media.
Yeah, follow Bryce on Instagram because he doesn't shut up about this Instagram account. All he talks about these days is his most recent post on Instagram.
Equity Mates _ investing podcast. If you're looking to follow our Instagram, it's going at the moment.
It is Bryce's pride and joy.
Yeah. Well, you got to start somewhere.
Yeah. Anyway, let's. Speaking of starting somewhere,
yes.
We did this series before, and we're going back to it because we think it's important and it's something that we wish that we had when we started, and that is Pardon the Jargon, where we break down 5 confusing, unnecessarily complicated,
but common,
very common. Investing terms.
Yeah. 5 terms that will send your head whirling if you have no idea what they are, but you'll probably see them a lot in the investing world. So, Ren, you've chosen out a couple of doozies.
Yeah. Now, the reason that I've chosen some of these, well, 2 of them in particular, is because they just did my head in. I kept seeing them and I was just like, why? Like, why use them? Is it really that important? Now that I know what they mean and I know how they're used, I still reckon
it's a bit of a wank.
Yeah, I was that was the word I was going to use, but I was biting my tongue because I figured we're a family friendly podcast. And
what else? Yeah, what else could we? Anyway, I've said it. So.
Yeah, you've said it. You said it to everyone. Bryce said it. But yeah, all right. Well, let's start with those 2, and then we'll get on to the other 3 terms, which some people might know, but I think they're important to understand.
Absolutely. So
the 2 terms that we're referring to are alpha and beta.
Boom.
You might have heard of them if you did cadets at school and you learnt the phonetic alphabet, or if
you're in a frat camp.
Yeah, if you're in an American college, or if you speak Greek.
Yes, if you know the Greek alphabet.
Yeah, or if you're investing
nerd.
So let's start with alpha because it is the beginning.
Yes.
Now, you'll hear people say, I do this and it provides alpha, or I achieve alpha from doing X, Y, and Z. And you might be thinking, what are you talking about?
Yeah, he's not talking about his ego in the trading room and the alpha male walking around making
That's
epic
not bad.
trades.
I didn't think of that one. No.
Oh, is that what it means?
No. So alpha is quite simply an outsized return generally measured against a benchmark. Yep. So what do we mean by that? If your standard market has risen 7%, say, and your portfolio increases by 9%, then you've had 2% alpha. It's outsized returns against the broader market.
Yeah.
So people, when they say, I provide alpha by doing this strategy, it means I beat the benchmark. I achieve outsized returns.
Yeah.
Or, it is really just, that's all it is. It's just investing edge, a way to get ahead, shorthand for sort of how they beat the general market.
Yeah. You'll often hear fund managers actually say that or read about it, that they provide alpha, high alpha.
Yeah.
It's just them talking themselves up a little to say that they are good enough to outperform the market. But statistics show that a lot of them don't have alpha.
Yeah, or if you do have outsized alpha for a couple of years, you generally regress to the mean. That's what we've seen with guys like Bill Ackman recently, but let's not get too much into that because that's not Pardon the Jargon. That's Alec's rant.
Nice one, Ren.
So the flip side of alpha is beta.
Yeah.
Alpha measures your returns. Beta measures your risk. So beta is a measure of, they call it risk, but it is actually a measure of volatility, and they use that as a proxy for risk.
Yeah.
So what do I mean by that? Volatility is how much the price of a stock moves or price of an asset moves. Shares are a lot more volatile than your house, I guess, is an example.
Yeah.
And so in this case, people talk about beta as risk. So they say, oh, well, your share is moving around so much, it's going up and down every day. Your house is staying, the house price is staying very consistent over a long period of time. It might change a tiny bit, over a month. Therefore, your shares have a lot more beta than your house.
Yeah, my understanding as well is that it's a multiplication factor as well. So correct me if I'm wrong, Ren, but I thought that if, say, for example, a stock has a beta of 3, then it's supposed to go up or down about that times of the index, if that makes sense.
Yeah, you're right.
Yeah.
Yeah.
By that factor is the word I'm looking for. Yeah.
So, in your example, if the benchmark is the S&P 500, say, the American market, and the stock that we're talking about has a beta of 3, that means it's 3 times more volatile than the broader American market.
Yeah.
I think Amazon has a beta of about 1.6, so it's about 1.6 times more volatile. Yeah, so look, I have a philosophical issue with this, and I'm sure people will disagree with me, but I don't think that volatility and risk are the same thing. If people want to read a whole book on it, Nassim Taleb's Black Swan is a good one. Volatility is the movement in price. Risk is the danger that you will lose your money.
Yeah.
They're different things. Unless you're, a year away from retirement, then volatility can really hurt you because you don't want to have to be forced to sell at the wrong time. But for most of us, your shares can move day in, day out. That doesn't matter. As long as you're not in a position where you're going to lose everything, who cares how much they move in a day or a week?
Yeah.
What matters is where they're going to be in 10, 20 years from now.
Yeah, agreed. And it's interesting, I've been reading about ATR, the average true range, when we're talking about stop losses and that sort of stuff, trying to actually determine what is the true, the best point to put a stop loss on. You need to take into consideration not only the closing price of each day, but also the volatility that occurs within that day. And as you said, Ren, it could move up and down throughout the day, but at the end of the day, the closing price trend could be constantly up. So, you're right in saying that risk and volatility are 2 completely different things. I just want to add with beta, there's a reason that beta shares is called beta, and we discovered this when we spoke to Elon, and that's because beta obviously is trying to, if it's 0 beta, then it's matching the index, and that's what they do. They're in an ETF. So there's a fun fact for the day.
There you go. And we didn't spruik it at the start, so why not spruik it in the middle? If you haven't signed up for our hashtag financial goals, I think is the title of the event, but it's essentially we're doing a live event, one in Melbourne and one in Sydney with beta shares. Elon will be there, we'll be there, and we're going to talk about all things ETFs, investing, financial goals, and equity mates.
Yeah, nice. I'll give it a plug at the end. We'll
Okay.
continue with
Sounds
jargon,
good,
and then
sounds good.
everyone stick around because it's a doozy of a plug.
Yeah, if you sign up before we get to Bryce's plug at the end, it means you can skip it. So get online and sign up now.
Okay, so we've done alpha, we've done beta. We're going to do gamma. Nah, just kidding. The next one we've got on the list, Ren, is blue chip.
Yes, that's a chip that's been sitting in your cupboard for way too long.
Yeah, well, I think Doritos actually released a line at Halloween that had blue and green chips in it.
Okay.
So there we go. We've got two definitions of blue chips so far, both of which are irrelevant to investors.
So look, people probably have heard of blue chips, but it's just a good term to know in case you haven't. Blue chips are your nationally recognized, well-established and financially sound companies. They're considered to be very reliable investments because they're known to weather downturns. They are profitable regardless of the broader economic conditions. And they're just long-term, stable, reliable companies that just grow slowly, but grow.
Yeah, and you'll often hear when people are giving new investors advice, blue chip always comes up. Oh, just throw it in a blue chip. I'm going to invest in blue chips. No, they're not investing in blue poker chips at the poker table at your local casino. They are investing in, as you said, Ren, reliable companies. So some companies in Australia that come to mind that would be classified as blue chips are obviously your BHP, Rio Tinto, Telstra, Commonwealth Bank, these sorts of stocks. Maybe not.
Don't know about Telstra.
Yeah.
That got taken out of my list. But yeah, the other ones I had are Wesfarmers and Woolies, CSL, Transurban, Macquarie Infrastructure.
Companies that usually pay a very healthy dividend aren't going to give you amazing 100% returns on capital at this stage in their business cycle. You never know. I'm not saying they won't, but they just kind of plug along. And yeah, you're not going to lose all your money, but you're also not going to make 1,000% on them.
Yeah. Now, before we move on from blue chips,
yes,
I have a question or two questions for you. So where do you reckon the name blue chip came from?
To do with the workers who worked there.
Elaborate?
Blue collar workers.
No,
am I right?
No.
Damn.
So it came
I thought
from...
it was pretty good.
You almost touched on it accidentally before. It actually comes from blue poker chips.
Oh.
When people were playing back in the day with poker chips, there were blue, white and red chips, and blues were the most valuable.
Wow, there you go.
And then when do you think the term blue chip was first used?
In the 20s.
Oh, mate, you nailed it. 1923 by Oliver Gingold, referring to stocks trading $200 or more.
Wow, so it was a price thing back then.
Yeah, it was.
And that's an expensive stock for the 20s.
Yeah. But
wow,
importantly, it's not based on price these days. Blue chip is broader than that. But back when it was first used, that was how it was used.
Wow, there you go. I wonder what the companies were. That's for another podcast.
Yeah. I don't know if that'll make it into a podcast. But
all right,
maybe that can be your Instagram post for today.
You're on the money. I'm going to do it. If anyone wants to know, I'm going to do it.
Yeah.
So we've got alpha, we've done beta, we've done blue chip, Ren, and now we're going to do one that is very topical at the moment and one that we've been talking about for a while, and that's index.
Yes, index funds.
So you'll find index in books, in an atlas. Where else?
Oh, you put me on the spot. Body mass index?
Yeah, no. So anyway, investing related index. What do we got, Ren?
So an index is just simply a basket of stocks. It's generally defined by certain parameters. So the most famous indexes are the biggest companies in a country. So for example, in Australia, the most famous index is the ASX 200, the 200 biggest companies in Australia. In America, the S&P 500, the biggest 500 companies publicly traded in America. But that isn't what all the indexes are. Indexes can also track different industries, different markets, different commodities, different assets. Yeah. So, for example, you might have an index that tracks
luxury cars.
The price
of luxury cars.
Yeah. Or you might have one that tracks Picasso paintings. Or you might have one that tracks transportation stocks. So, your Fords and your Teslas and your General Motors. And the way that index is constructed is generally it's based on the size of the companies in the index. So that's called market cap weighted. And that is really just the biggest company in the index moves the index the most, and then it's on down from there.
Yeah. Perfect example of that would be the NASDAQ 100. It's an index that follows the top 100 highest valued companies in the tech industry in America, and the top weighted companies in that index are, the likes of Facebook and Google and Amazon, etc. And so obviously the more they move, the more the index moves. It's the companies at the bottom that are the 95th, 96th, they may move 10 or 15%, and they're not really going to have much of an impact on the NASDAQ 100.
Yeah. Now, the reason that we've included indexes here, and if there's only one thing that you take away from the discussion of indexes, it should be this, is that indexes are nothing more than their underlying shares. So indexes are just a neat way of presenting what is a basket of shares. When you talk about the ASX 200, that is literally just adding up all the 200 biggest companies in Australia. And then when you talk about the movement of the ASX 200, that is literally just the aggregated movement of all those 200 underlying companies.
Yeah.
So when you talk about index investing, when you talk about what an index has moved, you were really just talking about the companies that are underlying it. And I think that people in this age of ETF investing and index investing, just putting their money in an index and leaving it, they forget that really all they're doing is putting their money in a wrapper that wraps up the, however many underlying companies are there. It would be exactly the same as just splitting your money out based on market cap amongst those underlying companies.
Yeah, it's just a convenient and often cheap way to get access to the top 200 stocks or whatever the index offers you, rather than individually going and splitting your money through and paying brokerage on every single trade if you were to buy those 200.
Yeah,
that's essentially all it is.
Yeah. Now, I've got a question for you about the index.
Uh-huh.
What was the first index?
In the world?
Yeah, well, at least in the modern world, in the share market world.
The Dow Jones.
Be more specific.
The Dow Jones Industrial.
Bow bow.
Damn. What was it?
The Dow Jones Industrial Average was created in 1896, but that wasn't actually the first index. The first index was the Dow Jones Transportation Index.
That's what I said.
Which was 14 years earlier in 1884. Made up of 11 stocks, 9 of which were railways.
I've got a question for you, Ren.
Okay.
Does the Dow Jones Transportation Average, whatever it was called, still exist?
Yes, it does.
Nice.
I just Googled it earlier though, so I'm cheating.
But now the Dow Jones Industrial Average is far more common than the Dow Jones Transportation mincy little one with 11 stocks in it.
I'm backing it for a comeback. I reckon railway stocks should
This is another moment on Equity Mates where Ren puts in a big call and it may come true.
I've been pretty good at this so far. Yeah, so let's see how it goes.
Mark this episode.
Also, if I haven't made it clear on Equity Mates yet, I have a theory about Elon Musk and all of his companies. Have I said it already?
Yeah, of course. We had a whole episode.
Oh,
on it.
true.
I'll do a social media post on it.
Okay, great. I just, if it happens, I want the credit.
Oh, absolutely. We've got it on air.
Yeah, great. Yeah. All right. Anyway, back to Pardon the Jargon.
The last one. The last Pardon the Jargon, something that's quite important, I guess, to understand and on almost every sort of financial metric and a lot to do with index is market cap or market capitalisation.
Yeah. Now, ironically, if we had planned this episode better, we would have done this one before index. But hey, you live and you learn.
Fast and loose.
So, market cap, what is it? Why do we care?
So market cap or market capitalization, I think we have touched on this in a number of episodes, but it is the total value, the stock market value of the company. And all it is the number of shares on issue that are available to purchase or have been purchased times the current share price. Now, a great example of market cap, and if you've been following our Instagram, I did a post recently about Apple hitting $1 trillion in valuation, and that was a direct reference to its market capitalization. That was the value of all of its stocks, all of its shares on offer times its share price, and it hit $1 trillion. So that's essentially market cap in a nutshell.
Yeah. Now, the reason that we included market cap and the reason that we think it's important is people get so hung up on share price. It is, it's obviously all that is reported in the media, and you see it, and so you see it everywhere. It's on the stock ticker, share price, share price, share price. But really, what is actually important isn't share price, it's market cap. Because share price is only half the equation. The classic example is Berkshire Hathaway, Warren Buffett's company. His share price is $300,000. But as a company, Berkshire Hathaway isn't more expensive than Apple. As a company, Apple is the largest in America. It is worth over $1 trillion, but its shares trade, I think they're in the $200 range. They just got over $200. You to understand a lot of the company metrics, you need to understand what the company itself is being valued at, not what one share is being valued at.
Yeah.
So it's always important to look beyond the share price.
Yeah.
Yeah. And sorry, just to finish, that's, when you're looking at things like how much debt the company has, how much revenue the company has, you don't want to compare it to the share price. You want to compare it to the value of the company. And then you can divide it by the number of shares and go to, earnings per share and stuff like that if you want to. But yeah, it's always good to look at the company as a whole.
Yeah, it often gives you an indication of sometimes whether or not the investors have gone a little bit crazy with their investing into the company. One comes to mind. It's a company in Australia. I won't name it, but it's trying to target the Daigao industry, which for those of you who don't know is an industry of sort of grey market retail where a lot of shoppers shop on behalf of Chinese and then send Australian products over to China because our quality is a bit better than theirs in certain parts of retail. But anyway, this company decided to go public. They have 4 shops in Sydney that specialize in Daigao, and these guys go in there and shop on behalf of them. And it has a market cap of about $80 million. And their profit margins are minuscule, and their turnover is not even in the tens of millions. It's in single digits. So you kind of look at that and go, market cap, tens of millions of dollars, but the business itself is literally just 4 small stores in Sydney. Like, what's going on here? So that's my little story for the day, Ren.
There you go. Now, my question for you before we finish up, you talked about Apple being worth $1 trillion. Was Apple the first company to be worth $1 trillion?
Well, this is a trick question, I think. In US history, Apple is the first listed company to be worth $1 trillion.
Yeah, but that wasn't the question I asked, was it?
No, but I haven't finished my answer.
Okay.
So I'm going to say no. 1 point to me. I'm also going to guess the country where the first stock was, first company was valued over $1 trillion.
New Zealand, yeah.
Say,
tough guess, mate. Come on.
I'm going to say China.
Yeah.
And I'm going to say it must be some sort of government organization. It's in utilities or oil, or well, not oil. They don't have a lot of oil, but something along those lines. It's a Chinese company.
Mate, you rambled yourself out of an answer there. You should have just stuck with China because it is in oil.
Oh, it is?
The one thing that you defined yourself out of.
Oh, no.
Yeah.
Oil in China.
Yeah, the company was PetroChina, And in November 2007, it hit $1 trillion.
Wow.
Somewhat controversially, but not worth getting into. And yeah, so that was the first publicly traded company. The first company valued at $1 trillion. Well, at least I'm pretty sure, this could be wrong, but I'm pretty sure the first one, but definitely one that has been, is the Saudi Aramco company, which is the Saudi Arabian-owned petroleum company. So there you go. 2 oil companies and a phone manufacturer have reached $1 trillion.
Oh, mate, they're more than a phone manufacturer.
Now, here's what I was thinking. What's the
Yes.
next thing? So, like, we had million, we had billion, we had trillion. What's the next number?
Oh, mate, it's 100 trillion.
No, but like, what's 1,000 trillion?
That's it.
No, because
It's a Google.
then you're done. Because you know, like 1,000 million is a billion. 1,000 billion is a trillion.
We won't see it in our lifetime, so we don't have to worry about it.
Oh, don't know, mate. I reckon you'll be
no,
the
we
first
may.
gazillionaire.
There you go. It's a gazillion. Exactly.
Nah, there's definitely a number, and it shows that I dropped maths in year 11. So if anyone out there knows what the next number is, please let me know.
Yes. So yeah, if you want to hear Ren ramble on and talk about maths and stuff, then do not sign up for our finance goals. Make your money grow with you.
I got the answer. I just
masterclass.
googled it. It's a quadrillion.
There we go.
Yeah, I'm
Interesting.
thinking Equity Mates might be the first $1,000,000,000 company.
Something to aim for.
I'll give you the rest of the numbers at the Equity Mates Financial Goals event.
Yeah, speaking of Ren, and I know you started plugging it before, but I'm going to do a quick plug now. It's exciting news for us. We are going to be on the circuit hitting Sydney and Melbourne. We're teaming up with Beta Shares and through General Assembly, which is an organisation that provides educational classes and seminars and all that sort of stuff. We're going to be doing a masterclass in Melbourne and in Sydney in September. The name of the night is #Finance Goals, Make Your Money Grow for You. And it's going to be a super fun night. We're teaming up with Beta Shares. They're bringing the investing experts, obviously not us. They're bringing their founding members, who is Elon, Israelstam, and their marketing manager, Ellie, and they're going to be talking all things investing. We're going to be going through Investing 101, breaking it down so you can start to build it up. We're going to be looking at ETFs, the essentials behind exchange-traded funds, and we're going to be looking at 3 investment ideas for the 21st century, looking at things like global technology, cybersecurity, and ethical warriors. But the good news is, Ren, is that after the Beta Shares experts and professionals give you a lot of information on all that sort of stuff, we're going to be rocking on stage and doing a masterclass with Equity Mates. So we're going to be up there and just pretty much sharing our highs and lows of our investing journey. It's going to be a Q&A style session where you guys can ask us all the questions you want. We're going to share some of our major lessons that we've learned over the years and just, give you the lowdown on what it was like to start investing. No sort of BS. It's just going to be a cracker of a night. The details are Wednesday, 5th of September for Melbourne, Thursday the 13th for Sydney. Both events are free and, we'll put on some drinks afterwards at your cost. We won't be paying for them.
I was going to say, mate, what are you promising here?
We'll meet at a pub, and it's from 6 till 8 p.m. So it's going to be a super fun night, a great opportunity to come down, get an understanding about ETFs, and also ask any questions you want. Obviously, we're encouraging all of our listeners to come along. It's free. But if you have any mates who would like to start investing as well, the Beta Shares guys are super cool. We've interviewed them before and had a great time. So, yeah, that's it.
Nice one. I said at the start of this episode we should say 35 minutes or less.
Uh-oh.
We're coming up on 31 minutes. So,
Dang, that was a big one.
yeah, I just think that's our new slogan.
All right, we'll revise it, Ren, at our next strategy day.
All right. Until next time.
That's it.
That's it.
Hello, mates of Equity Mates. Or I guess that just makes you Equity Mates. Anyway, it's Bryce here. One of the most frequently asked questions we get is, where do we find information about all these stocks and where's a good place to start? Now, we could do a whole episode on this, and we often do touch on it, but the best place to start is by signing up to our Thought Starters weekly email. Each week, we send you some cool stuff that has caught our eye during the week, as well as some more detailed articles on stocks and invested-related content. We also include Basics 101. These are articles tailored specifically for beginners to really propel you on your way. We don't spam you. I mean, we hate spam. It's once a week, and there's enough stuff in there to occupy you for a full day of browsing at work. Now, Ren puts a lot of effort into finding quality articles for you guys, so if anything, just sign up so he feels the love. Head to equitymates.com and chuck in your email at the bottom of the page.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.